Okay, so you've probably seen the headlines everywhere. The Federal Reserve is cutting interest rates. Again. But what does that actually mean for your mortgage, your credit cards, your savings account? Well, in the next few minutes, we're going to cut through all the noise and build your personal financial playbook to really take advantage of this new rate environment.
So here's how we're going to break it down. First, we'll cover the Fed's latest move and what it means for you personally. Then we'll dive right into the playbook with real strategies for managing your day-to-day cash flow and growing your long-term wealth. And we'll wrap it all up with what we're calling an all-weather plan to help secure your financial future no matter what happens next.
All right, first things first, let's get a really clear picture of what the Federal Reserve actually did, and maybe more importantly, why they did it. I mean, you see the news, you hear all the jargon, but the real question is, why should you even care? Well, it turns out this one decision creates a huge ripple effect that touches pretty much every single part of your financial life.
See, it all starts with this thing called the federal funds rate. Just think of it as the foundation, the bedrock interest rate for the entire economy. So when the Fed makes a change here, it sets off this chain reaction, and that's what influences the cost of everything from your credit cards and car loans to your mortgage and even the interest you earn in your savings account.
And look, this isn't just a one-time thing. We're talking about a whole series of cuts, 6 of them actually, since September 2024. When you add it all up, the Fed's key rate has dropped by a total of 1.75 percentage points. That is a really significant shift, and it's what lands us in this new target range you see here.
But, and this is a big but, don't just assume the cuts are going to keep on coming. This recent comment from Fed Chair Jerome Powell, it's a signal of caution. He's basically saying, hey, we're going to pump the brakes and see what happens. That creates a pretty complex and, frankly, uncertain landscape for all of us.
Okay, so let's connect the dots. Let's go from that big, high-level economic picture right down to your personal bottom line. How do these decisions actually show up in your wallet?
This is where the rubber really meets the road. You can see the real dollar impact here. A single rate cut might not feel like a big deal, but they definitely add up. On an average new car loan, you're maybe saving about $17 a month. For a home equity line of credit, a HELOC, it's a more noticeable $100. But look at mortgages. The potential savings can jump to over $580 a month compared to where rates were at their peak.
And as Michelle Ranieri over at TransUnion points out, while some of these savings are small, others, especially on those bigger loans, are really becoming significant enough to truly impact a family's budget. It's starting to make a real, tangible difference.
Okay, so we get the landscape now. It is time for action. Let's jump into the first part of our playbook, practical, real steps for managing your daily cash flow and your debt in this new environment.
I absolutely love this concept from financial planner Nadia Vanderhall. Her advice is brilliant. She says stop just listening to the Fed and start acting like them. Manage your own personal finances with the exact same strategic mindset as a central banker. So how do you do that? Well, here's the game plan. First, you track your spending like your life depends on it. Think of it as your own personal inflation report. Second, you adjust your savings goals every quarter, just like the Fed releases new projections. And third, you got to be proactive. Pick up the phone, call your creditors, call your service providers, and negotiate for lower payments.
Vanderhall's mantra here is just so powerful. Plan it, don't panic. When you have your own data, right? Your own personal economic report, you can make these smart, strategic moves instead of just having emotional, panicked reactions to whatever the latest headline is. You are in control.
Now, let's get a reality check, especially when it comes to credit card debt. Yeah, the Fed's cuts might save you, about $6 a month on an average balance? That's it, $6. Meanwhile, the average APR you're paying is still a massive, almost 20%. So these rate cuts, they're just a tiny drop in a very big, very expensive bucket.
And this is exactly why Bernadette Joyce says that paying off high-interest debt is literally the best investment you can possibly make. I mean, think about it. You can't find a stock, you can't find a bond that will consistently give you a 20 or 25% return. But paying off that credit card, that is an immediate, guaranteed return on your money.
This way of thinking also applies to your savings. With those high-yield savings account rates dropping from their 5% peaks, Bernadette Joy reminds us that just letting cash sit there isn't the slam dunk it used to be. So instead of just parking it, you need to give every single dollar a specific job, whether that job is paying down debt or getting invested for the future.
So, once you've got your daily cash flow buttoned up and under control, you can start to focus on the next part of the playbook, building that long-term wealth.
Financial analyst Stephen Cates recommends what he calls a building blocks approach. Before you do anything fancy, you have to secure your foundation. So,
First, build a 3 to 6 month emergency fund. No excuses. Second, always contribute enough to your 401k to get the full company match. That's literally free money. Third, if you have an HSA, a health savings account, max it out. Then, once all that is covered, you aim to save at least 10% for retirement. These are your non-negotiables.
Now, for anyone out there with variable rate debt or a high rate mortgage, this analogy from Michelle Ranieri is just perfect. Think of it like a game of musical chairs. You do not want to be the one left standing when the music stops and rates start to creep back up. The time to lock in a lower rate by refinancing is right now, while you know for sure the savings are there.
And here's her super simple rule for deciding whether to pull the trigger on a refinance, and this goes for a mortgage or even a car loan. Just do the math. Add up all the fees, and then compare that to what you'll save in interest over time. If the numbers work in your favor, it is a smart move. Don't sit around waiting for some perfect rate that might never even show up.
All right, finally, let's zoom all the way out. How do we tie all of these pieces together into one resilient strategy? Something that doesn't just work today, but can weather any kind of economic storm that comes our way.
This quote from bank CEO Patrick Ryan really gets to the heart of it. A truly solid financial plan shouldn't need a knee-jerk reaction every single time the Fed makes a move. The real goal is to have a long-term strategy that stays on course regardless of these short-term changes.
And really, it all comes down to this. The interest rate environment is just one part of the constantly changing economic weather. So take a hard look at your own strategy and ask yourself this one simple question. Is my financial plan truly built to last?